Could you believe that a company used to trade at 20 bucks less than a year ago, increased its dividend by 6%, and today the stock is trading under 10 bucks and it cut its dividend by 40%. Yes, dividend investors, bonjour. My name is Mike Héroux and I'm founder of Dividend Stocks Rock. I'm also a passionate investor, and today we are talking about Algonquin Power and Utilities that have failed their shareholders last week on an investors update call where they said, you know what? No more drip, we cut the dividend, we continue to pursue our acquisition of Kentucky Power, which means getting more debts. We're also going to sell $1 billion in assets of renewable utilities, plus we're going to slow down our capex. A bunch of bad news. Stock didn't take it very well, but that problem started a quarter ago. So today we're going to look at what happened with AQN, and then what are the lessons that you can learn from that? And I'm going to tell you at the end of this video what I've done with my shares, and also how to avoid the next AQN in your portfolio. You know, that is unfortunate, but even the best investors in the world will make mistakes. I did a mistake with Algonquin, and many others also did the same one. The thing is, even good stocks could turn sour. If you look back in the day, over the past 10 years, Algonquin has been a darling among dividend growth investors. Actually, everything was there to like, right? The stock was going well, revenue was growing, earnings was a bit shaky, but overall, they were earnings per share. They were still growing year after year. And then came the dividend increase every single year for roughly 10 years. So what could go wrong? I mean, a year ago, they just increased their dividend in June of 22, just to tell you, like a few months after, oh, you know what? You can't afford it anymore. So what happened is the company used the floating rate instead of going with fixed rate for most of these debts. We have highlighted that again and again throughout videos in my portfolio that Algonquin is a great utility business, but it has an aggressive growth by acquisition plan. They rack up more debt, they issue more shares to finance their project. So far, so good. Was not that a problem? First, because they benefited from very low interest rate, but also because they were able to generate earnings per share and funds from operation per share growth almost year after year. Actually, when you look at this graph, you can see that the strategy worked for most of the year until we hit 2021. At that point, the problem was the company continued to issue more shares and rack up more debts to pursue the acquisition of Kentucky Power. Funny fact, they got denied for the acquisition later in 2022. I thought that was a good sign. I also thought that the CEO buying for 1.5 million's worth of share as the stock was plummeting was also a good sign of confidence. So when they revised their earnings per share in November and they said, you know what, we're going to be down maybe like 8 or 9% on our guidance, stock price plummeted by 35% in 2 days. And then I thought, that's classic overreaction from the market. It happened several times in the past. It's going to happen several times in the future. And unfortunately, this time the market was right. And then we're going to see, and then you're going to tell me, but Mike, that was super obvious. It was obvious that Algonquin was in a bad situation and you should have sold at that time. Well, you know what? Between now and then, the loss isn't that bad. I could have sold on that Friday. Maybe I could have saved maybe like a 10-15% on the drop. But besides that, it was not that obvious. The company could have sold a few assets and then stop the pursuing the acquisition of Kentucky Power, and they could have maintained the dividend, because back then, back in November, the FFO payout ratio was under control. It was around 70%, so there was like no panic over there. The thing is, they keep revising their guidance. So they did it in November, but they did it again during the call. And now, obviously, the dividend becomes unsustainable. But keep in mind, we see this type of situation over and over again, and then we have plenty of people telling you, yeah, this company is going down, And when it doesn't happen, they just go silent and we don't hear about them anymore. And when it happens, everybody's like, hey, I knew that, that was obvious, but it's not that obvious. So here's how you can avoid making this kind of mistakes in the future. One thing that is super important, and I realize when I look at Algonquin, is I let the narrative take over the financial analysis. So you know, when you look at a stock, regardless if you want to buy one, if you wonder if you should sell one, or you just review your portfolio, you're going to look at numbers first. So obviously, numbers for the past 12 months were not that great. So yes, the dividend was increasing, the revenue was increasing, but revenue and FFO per share, that was not going towards the right way. Then you have all the financial metrics that you look at, and then you also have the narrative. The narrative is pretty much the story you tell yourself, the story that you tell everybody, what is the company's doing and how it's going to grow. So the narrative around Algonquin was, you know what, this is a grow by acquisition utility. So 2/3 of stable assets, regulated utilities, and then 1/3 in renewable energy that is trending, that is going to move forward, and now they're growing all the time. So yes, they rack up debt, they issue more shares, but their business model is working. So that was the narrative. Unfortunately, if you just let the narrative keeps on going, then you're going to enter into a gray area when numbers aren't that obvious. So when all the numbers goes up, everybody will agree, oh, this is a great business, and then you have the narrative, and then everybody's happy about that, right? But when numbers are going sideways, this is where it is very difficult to weight your number analysis versus the narrative. Here's an example. Let's take Microsoft back in 2017. So as you can see on this graph, revenues aren't growing as steady as expected. Earnings per share even less, but we got some good dividend increases. In 2017, most financial analysts would tell you Microsoft is overvalued. They don't have like super growth perspective going forward, and you're better off waiting a little bit, maybe to get the stock at 55 or 60 bucks. And that was pretty much the consensus. So now you know that if you bought the shares in 2017 at 75 bucks, you are laughing today. The company went straight ahead and it was generating a lot of money. So what was my narrative back then? Well, what happened is that during those years that you see on this graph, they went from we're going to launch a new edition of Windows or Office 365 or whatever to generate sales, to a subscription-based model. By doing this switch, it hurt EPS and revenue for a short period of time. Then we had the tax bill issued by the Trump administration that made some changes. It was temporary changes, but it affected the earnings per share, especially for Microsoft. This is why you see the big drop during 2018. That the year after, in 2019, it went back up right away. So looking at the number is one thing, looking at the narrative is another, but then you get into that gray area where all the numbers are not necessarily going towards the same direction. So yes, I've made a mistake on Algonquin, but I protected most of my portfolio. Why? Because I followed a strict investment process. I never let a company like Algonquin, which is more like an educated guess than a super solid utility business. Yes, I believed in that and I have a strong narrative, but I also always said that Fortis and Emera were my number 1 and number 2 as preferred utilities. I wanted to add Algonquin to my portfolio because I thought, hey, it's going to spice it up. It may generate more returns. But I didn't let it go to like 5 or 10 or 15% of my portfolio. I maintain a lower weight for this type of business because I know it comes with some risk. Now moving forward, even though we have a good start in 2023, don't necessarily think that all the bad news are over. We still have inflation, we still have higher interest rates, we still have war between Russia and Ukraine. And one thing that bugs me is that high interest rate is lagging. It will have a lagging impact. What it means is, well, if you have your mortgage and only renews in 3 years, you don't care about what interest rates are right now, right? But in 3 years from now, when you're gonna renew, then you're gonna scratch your head and then you're gonna wonder what's gonna happen with your mortgage. Well, this is exactly the same thing with companies. They will have maturity, the debt maturing like this year, next year, and so on. But as they renew their debt, then they're gonna see the burden going up in terms of interest payments. And then some companies may say, you know what, similar to Algonquin, that, keep in mind, had the same credit rating than Fortis right now. They say, oh, you know what, now we're getting a bit squeezed by interest rate and we're not too sure where to go. So you have to be very careful about that. You have to focus on companies that you would qualify as your core holdings. Companies with not only a strong narrative, a strong investment thesis, but also with a strong numbers. So revenue growth, earnings growth, dividend growth, low payout ratio, some growth perspective, solid cash flow, robust balance sheet, and so on. Try to be a little bit more pickier in your stocks. And right now, if you look at your portfolio and you identify other companies that would qualify as an educated guess, maybe it's the right time to get rid of them and then strengthen your portfolio by becoming more stricter in your investment criterion, by looking at companies that has a very long track record of dividend growth. You're going to secure your retirement plan, you're going to secure your dividend income, and you'll be able to move forward. Now let's go back to Algonquin one last time. I told you that at the end of this video, I would tell you what I've done with my shares. I know that some investors are staying put. They're just gonna wait, and then the yield is still good if you look at how much they're still paying the dividend. Apparently the dividend will be safe moving forward. This is pretty much always the same story that CEO will tell you when they cut their dividend. And some others will jump in now because now all the bad news has been priced in and they think that the company will move forward and the stock price will increase. On my side, I decided to sell my shares. Not because of the loss, because yes, it sucks, but it's not because I'm losing 50% on an investment that I'm going to actually press on the sell button. The problem came during the investors call. So first, they cut their dividend. That's a big no-go for me. But second, they went with this great presentation telling you that they expect the earnings per share to grow by 5 to 8% moving forward. They tell you that they're going to sell some assets, but they don't tell you which one, but it's going to be better for the business. And they tell you that they're going to acquire Kentucky Power, so they're going to file again because they got denied by a regulator to make this business grow and generate more earnings per share moving forward. And now you take a pause and then you think, this guy, this CEO came in 2020 and he was saying, oh, we're gonna reach EPS of like $1 per share, not too far in the future. Today in 23, they expect between 55 and 61 cents. Pretty far away from that $1, right? But things changed, that's all right. And now, after the call, after the presentation, we get analysts asking questions. And this is the most interesting part of that call. Because now analysts started to ask questions about the fact that if you're selling assets, it's going to affect your ability to generate earnings, right? You're gonna get a big check, but after that, you're not gonna generate earnings per share. If you're going after Kentucky and then you're issuing more shares, so you're going to dilute the value one more time, what's going to happen with the EPS? It's going to put pressure on it, right? And what's going to happen with that 5 to 8% growth? And then management was first super vague about the asset they're going to sell. They're just saying, oh, we're going to look at it. So we're not going to disclose any information on that. So we have no clue if they intend to sell their stake in Atlantica Yield or not, which is 42% of shares. We don't know like which type of assets it will be renewable, but which one will be sold and how it's going to affect earnings. And we don't know exactly the pressure it's going to be put on the earnings per share as they create more share dilution in 24 and going forward. So they've been vague, they don't tell you everything, and now they're saying, oh, but you know, the 5 to 8% EPS is our North Star. It's our like long-term goal. So long story short, they're telling you short-term, we have no clue what's gonna happen, and we don't know how it's going to affect the new payout ratio, and we're not too sure where we're going. So this call was all about trying to strengthen their balance sheet, trying to keep their credit rating intact, because if they mess up with credit agencies and now they're getting downgraded, the problem would be huge because the burden of their debt will just increase even more, and then they could get into even more problem. And this is what I want to avoid with Algonquin. I don't think that they're out of the wood yet. Cutting down the dividend and selling assets will just not make it. There are other problems that is moving forward, and I have lost confidence in management, and that is probably one of the most important thing. Is now my narrative, my investment thesis doesn't work anymore for me. So on top of the dividend cut, I don't have any confidence in that company, and I decided to sell all my shares after the call. So I took the loss, I move on, and now I'm going to invest that money elsewhere. I think it's going to be better for my portfolio over the long term. But again, as I mentioned earlier, because it was a small portion of my portfolio, it doesn't affect much my total return. So the total return on that stock is bad, but the overall picture is not that bad. So now I'm curious a little bit about what your perspective on Algonquin. Did you sell? Did you buy more? Are you sitting tight? I'm sure that you are frustrated right now because it's not fun. I was not happy to make that mistakes, and I mean, to be honest, I got two big losses in my portfolio in 22, Algonquin and Sylogist. That was definitely not a good year for my portfolio, that is for sure. But the thing is, you have to learn from those mistakes, and what I've learned is to be a little bit less patient with my narrative moving forward and let the number speaks a little bit more, especially now that we will be in a higher interest rate environment for several years. I think it is time to for each of us review our portfolio and make sure that we have core holdings that are very solid. So let me know in the comments, what do you think about AQN, what you have done? Give me a thumbs up, and don't forget to, until next Thursday, where we're gonna talk about Apple's problem. Stay invested.